Our next guest says the recent weakness in equities is more of a near-term correction, not a broader market sell-off. And in the shorter term, markets could see some further upside. Let's get more from Sahak Manuelian, Managing Director and Head of Equity Trading at Wedbush. Sahak, thank you very much for joining us. First of all, what's your take on what how the markets interpreted what the Fed had to say yesterday?
I think coming out of the Fed meetings yesterday, it was certainly skewed to the dovish side, and I think we saw that with the markets rallying yesterday. We came in this morning, futures were down a little bit, and they rolled over kind of hard this morning pre-open here in the U.S. I think Lagarde had some comments overseas in Europe, which put some pressure on the markets early, but we've really shown that off and rallying since then, and markets look to be in pretty decent shape here. And I think Jay Powell's done a pretty decent job of telegraphing everything up through now, and I think investors felt pretty dovish, or felt his remarks were fairly dovish yesterday coming out of that meeting.
Did the critique of the Fed yesterday of the tariff situation and the impact that tariffs might have on U.S. inflation, the word transitory was used, which investors have heard before. Did that reset expectations, or did it ease worry about what U.S. trade tariffs might do to the U.S. economy?
Yeah, transitory. I think folks try to really harp on that and really focus on that, given the transitory statements that had been made in the past and weren't transitory. I think much of this is probably priced in. I don't think that word played as much into what markets have been doing as maybe it has in the past. I think that investors today are certainly very nervous or worried about exactly how the tariffs play out. But we'll see how this stuff comes together here as we get into April 2nd.
So markets have declined, obviously. U.S. markets have and clarity. U.S. markets have declined, obviously, so far this year on these worries. But you believe this is a correction and not the beginning of a bear market, correct?
I do believe that we've had quite the correction year to date, and if you just take a look at the February 19 all-time high, as of last Thursday, anyways, we were down some 10.2%. So we've certainly corrected here in the near term, though we got to oversold conditions technically, and then not to mention some of the degrossing and de-risking that funds have been doing. I think we got to a level where it's safe to come in and start buying some things. Now, having said that, I think it's very important that folks are careful in what they are buying, know what they're buying, and really, I think that the rotational forces that we've seen underneath the surface will continue to take hold, meaning some of the laggards over the last 2 years, namely energy, healthcare, which have been outperforming year to date, will probably continue to do so. And I think some of the winners from the last couple of years, tech and consumer discretionary, probably continue to be a source of funds for investors.
Okay, one sector you like is the home building sector, and one stock within that sector you like is Toll Brothers. Tell us why.
Sure. So you can take a look at the chart of Toll Brothers. It's had a tough go at it thus far this year. I think investors are pretty cautious about the builder group in general, given some of the macro headwinds and namely eroding consumer confidence, slowing growth, et cetera, which typically is not good for home building. Look, we think that much of this is probably baked into this already. They've come down. Toll certainly has come down enough where we think the risk reward here for the stock is fairly compelling. And we think that we do see a pretty decent second half and that they'll be able to hit their metrics the second half of this year.
Within tech, and you mentioned tech just a second ago, one stock you like there is Micron Technology, the chip maker.
Sure. Certainly a lot of moving pieces within technology and such a wide array, but Micron Technology reports today after the close. I think sentiment is probably slightly skewed to the positive side, given some of the recent data center tailwinds. we like Micron here. We think investors might be a little bit nervous about PC or smartphones, heavy CapEx spending, growing competition from China, et cetera. But we think actually conditions will probably improve here second half of the year. We also think that the stock is cheap enough, or valuation is compelling enough here where risk reward, again, it sets up well.
Okay, and finally, from a completely different sector, in the restaurant sector, you like a stock, Cava, the shares of Cava Group. Tell us why.
Sure. This Cava Group came public not too long ago. This stock is down some 43% from the highs we saw in February. So many of these hyper growth stocks have just gotten crushed over the past 2.5 weeks. We just recently increased our Q1 same-store sales growth estimates. We think that this has come down enough. We think that people can come in and start buying this thing if you don't already own it. And again, we like the risk reward setup here for Cava, given where it's just recently come from.
So you said a couple of things about tech. What's your view of the broader tech sector right now?
I think the broader tech sector still remains very choppy. There's a lot of macro backdrop, administrative headwinds, et cetera. I think that within tech, folks have to be more particular than ever in stock selection. I don't think you can just buy these Mag 7s, which have been working the last 2 years. I think folks will have to be much more selective. However, given how much some of these names have come in from recent highs, they start to look a little bit more compelling here. And I think certainly in the short term, we can have some decent upside going forward.